Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
'Twas the last day before Christmas, and all through the markets fear shook the financial world, picking investor pockets. The scoundrel of our tale was not a ghost of Christmas past. It was the chairman of the Fed, who decided to raise interest rates a bit too fast. December 2018 was a month stock investors want to forget. But we must remind one and all that you get what you get, and we sincerely hope you're not too upset. The stock market has risen for nearly 10 straight years. The bear market now and then just happened, due purely to emotional fears. While no one can predict the next stock market low or high, the latest figures make the economic forecast very bright. Sparing you further rhyme, here's an analysis of the facts that won't take too much time. Hiking interest rates flattened the yield curve, the Federal Reserve's key lever of the U.S. economy. The yield curve, according to the Federal Reserve, is the difference in yield between a 10-year U.S. Treasury bond and the 90-day Treasury bill. At the start of 2018, the yield curve was much steeper. The yield curve on January 5th was steep in comparison to the yield curve on December 18th. The difference between the T-bill and the 10-year Treasury bond declined. On December 24th, after the rate hike, the yield curve flattened still more, and significantly. Looking back since 1983 at the movement of the yield curve versus the performance of the stock market, when the yield curve inverted in mid-2006 during the last economic expansion, a bear market decline soon followed, and that happened in the expansion of the 1990s too. Fearing a repeat of these historical facts spooked investors that the Fed might cause a recession and sent stock prices plummeting. But the real economy shows no sign of a recession. The economy is doing just fine. The consensus forecast of 60 economists polled in early December by the Wall Street Journal was for a 2019 growth rate of 2.3% in 2019. That's down from 2.5% last month, but certainly nothing like a recession in which the economy shrinks. It's actually strong relative to the last 2 decades. The forward-looking U.S. leading economic index rose in November, resuming its long ascent into higher record territory than it has ever been. The LEI has definitively collapsed many months in advance of the last 2 recessions. Nothing like that is happening now. Economists from the Conference Board, which collects this forward-looking data every month, said solid GDP growth at about 2.8% should continue in early 2019. The 2.8% growth expected by the Conference Board is much higher than the 2.3% consensus forecast of economists surveyed in the Wall Street Journal. In addition, the collapse of the LEI has often preceded bear markets in the past. The red circles highlight the start of sharp declines in the LEI before the last 2 stock market declines. December's stock market plunge was not preceded by a collapse of the LEI. This sharp drop in stock prices runs counter to this key benchmark for forecasting economic growth. The stock market was spooked by the Fed's hardline obsession, but economic fundamentals showed no sign of a traditional bear market recession. While the S&P 500 fell by 19.8% from its September 20th high, and that is scary sounding, it qualifies officially as a 20% bear market decline only after rounding. The Fed is not really a ghost, gremlin, or monster, and Mr. Powell is likely to do better in the future. With robust growth of the economy so clearly on the horizon, as bear markets go, this could turn out to be, relatively, a nice one. And besides, this is no time of the year to be caught up in a fright, so we end saying Merry Christmas and Happy New Year to all, and to all a good night.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.